Thank you for tuning into part 2 of this series. In this series, we will cover some basic information on these corporations and also cover some technical analysis. Please stay until the end for potential buy areas. Also, we would really appreciate if you would like subscribe and hit the bell. Happy investing!
We're just going to do a quick, brief technical analysis to see if this is something we want to invest in and make some money. Been around a long, long time. Well, there's a reason why they've been around a long time. That's because they're great companies. If they're keeping up with the technology, they'll be around for a long time to come. So first, we're going to look at the Coca-Cola company. The market cap is $272 billion, very large company. The current PE is 25, does pay a dividend. It's like the volume was 9 million on the 3rd, July 3rd, 2024. The average volume is 11 million. If we look at these numbers here, we're talking the last 5 years. Year to date, it's 9% versus the S&P is 16%, so it's underperforming the market. Last year was 8.53, the S&P is 24. 3 years, Coke was 28%, the S&P 27%. 5-year return, Coke is 42%, but the S&P's 5-year is 86%. Let's take a look at some of the technical analysis real quick. This particular platform is Thinkorswim, 1985. Coke was trading at a low of $1.24. The current high is $67.02. As you can see, you would have made a lot of money if you invested in Coke. And that's from 1985. That's not even going back to the early 1900s. So this company has done a great job for a lot of people. Going forward, I think the growth is going to be a lot slower. So this is just going to be one of those stocks that you can trade in and out of, you can invest in, it's going to receive a dividend. This is on the more conservative side of things. Let's take a look at the 6-month. So this is a 6-month chart, and we are currently looking at, for the past couple of months, it traded at a low of $57. Its current high is $64. It's currently in an upward trend, currently in an upward channel. As you can see, a lot of times stocks like to trade inside of channels. If you wanted to get in this, you could essentially get in at the 10-day, the 21-day, the 50-day, or the 200-day moving average. Typically anything trading below 50-day moving average, stay away from. Let's take a look at Exxon Mobil, closed July 3rd at $114.76. Let's take a look at some of the numbers over here. We've got a market cap of $514 billion. We've got a PE ratio of 14. We have a forward dividend and yield of $3.80 a share at 3.31% yield. Volume average is 17 million shares traded per day. The volume on Wednesday was 7.4 million shares. Past 6 months, it's returned 16%. The S&P 16%. A year, Exxon gave us 10%. The S&P gave us 24%. 3 years, Exxon gave us 104%. The S&P 27%. Exxon in the past 5 years is 94%, and the S&P 500 is 86%. So the moral to that story is, do you want to put all your eggs in one basket? The S&P 500, essentially, you're buying over 500 companies, and it's going to give you a good solid return versus being in one stock. You're subject to a lot of risk. Let's take a look at some of the technical analysis. In 1985, this stock traded at a low of $5.52 and currently closed at $114.76. The all-time high is $123.75. As you can see, This particular stock has just done very well over the years, pays a dividend. So the last 6 months, the stock was trading at a low 95.77, and then now it's reached 123.75. It's been in a downdraft for the past several months, and it looks like it's trying to form a bottom. Now the moving averages are starting to get into alignment. So the white line is the 10-day moving average, the purple line is the 21-day moving average, the green line is the 50-day moving average, and the red line is the 200-day moving average. Use moving averages, support and resistance areas when you're trading and investing in stocks. Even if you're investing, just don't throw your money in. You want to wait for the right time. Many of the institutions and the big money comes into these at particular times. They just don't put it in there when a stock is extended. This stock is not extended. It's currently in a retracement, but you need to do a little more due diligence and look at the entire sector, look at some of the other leading stocks in this sector to see if this is a sector issue or is this a company issue of why the stock is off. The Procter and Gamble company closed July 3rd, 163.83. The market cap, 386 billion. The PE ratio is 26. They have a forward dividend and yield, a forward dividend of $4.03 per share, and the dividend yield at 2.46%. The analyst estimate target is 160. Now we are looking at the volume on July 3rd was 2.7 million. Their average volume is 6.1 million shares traded per day. Let's see what this company would have done for us in the past 5 years. Year to date, 13%, the S&P 16%, 10% for PG, S&P 24%, 3-year return is 29%, the S&P 27%, 5-year return 66%, and the S&P 86%. Let's take a look at the chart. Let's max it out. So we're Procter and Gamble, we're on the max. This goes back to 1985. Of course, we know the company's been trading for over 100 years, but this platform only goes back to 1985. So what we're looking at, so from 1985, now of course, keep in mind, there's a lot of splits throughout the years that have happened, but the stock low is $3.15. The current is $169.41. In the past 6 months, the stock's traded from 146 to 169 and change. The analyst estimate was $1.70 a share. The actual was $1.84. So they beat the street. In this case, well, they gapped up, and their volume that they gapped up on was 19 million. And then it took off to the races. Want to get in when these stocks gap up, you could get in on the moving averages or support and resistance areas. It even touched the 200-day down here to reclaim the 10, the 21, and the 50-day moving average. It's currently trading below it though. So if you wanted to get in on this stock, would not get in on it until it recaptures these moving averages. The stock is currently in an upward trend, top of the range. You're going to have resistance here. We have support here. We're in a range, and it's at the bottom of the support area. So if you were looking to range trade, you could essentially get in on this area, put a tight leash on it with a stop below the low of 161.42, so you could go 161.32. If you get stopped out, you get stopped out. The stock's trading at 163. You know, this is going to be a slow mover. These companies that have been established for so long, they're going to be slow movers going forward. GE Aerospace closed July 3rd, 163. Market cap is 178 billion. The PE ratio is 42. Estimate target is 186.57. Now, does pay a dividend, and the yield is 0.69%, a forward dividend of 1.12. So we look at the volume on Wednesday. It was 2.5 million. The average volume for the company is 6.5 million. Okay, year to date, 60% for GE, 16% for the S&P, 86% for 1 year, 24% for the S&P. A 3 year for GE is 147. The S&P is 27. A 5 year return is 213%, and the S&P at 86.24%. This is going back to 1985. The low was 1155, and the all-time high 301.42 is the all-time high. Looks like here's going to be a level of resistance when we get there, and this right here is going to be a level of resistance that was established in 2016. So we are currently at a level of resistance. If we can break through this, well, then we're going to go up to the next level. So for now, we want to respect this area. So for the past year, the stock has went from $84 to $170. It's up 100%, in the past few months. So the stock has done very well. It's respecting its averages. The white line is the 10-day. The purple is the 21, the green is the 50, and the red is the 200-day moving average. Let's zoom in on this a little bit closer. It's in a consolidation period. We look at the last earnings. The estimate was 67 cents. The actual was 82 cents. So they beat the street, and the stock gaps up, and the volume has increased, and it pushes a little higher. This stock is going to be a slow moving train. It's going to be a slow coach, even though it's done very well in the past year. It's just one of those big global giants that it's been around a long time. It's a safe company to be in. And it looks like if you wanted to get in on this, we're right at the level. The challenge that you're going to have is we're at a resistance level from 2016. That's the only concerning factor I see here.
Thank you so much for watching. We hope this analysis gives some insight with your investing and trading process. We really appreciate your love and support. Please like, subscribe, and hit the bell. Always remember to dot your I's, cross your T's, and don't forget the Z. God bless and happy investing.